Some news on the New York Stock Exchange itself. The SEC has rejected a proposal from the New York Stock Exchange to allow companies to raise capital in direct listings. IPO alternatives like direct listings have grown in popularity. This year, we've seen Slack and Spotify go that route. The New York Stock Exchange commenting, "We remain committed to evolving the direct listing product. This sort of action is not unusual in the filing process, and we will continue to work with the SEC on this initiative." For more, go to CNBC.com. Of course, had an interview on this topic late last week, and it will be interesting to see if they can adapt their proposal to get to a point where they kind of go to a half-hearted IPO, as it were, via the direct listing process. The one group of people I think would be quite pleased they haven't got there yet are the investment banks, because if the exchanges can list and raise capital without that reliance of underwriting and the access to clients that the investment banks propose, I think you would have seen a slight shift in the pool of the fees for this from investment banks towards the exchanges. But we'll see how it goes.
Yeah, I mean, it just can't all be about fees, and I think the investment banks want to work with this as this process is evolving. But I'll just make one really important point. When you think about, as we get in the later stage of this IPO cycle, one of the most important reasons a company will IPO is to raise capital. When you do a direct listing, you're not raising capital. Go back 20 years from now, there was a lot of companies who went IPO'd in 98 and 99 who raised capital. That cash on their balance sheet sustained them during a very prolonged bear market. So that was really important. So I think that's really what has to evolve in this process.